Fenton here, founder of TickerTank.com. Just want to go over something real quick. I've received several emails over the past few months, and the gist of them seems to be fairly consistent. Nick, assume you have somewhere in the vicinity of $100,000 to keep things simple, and you're working off standard margin rather than portfolio margin. How would you go about allocating and deploying capital with that type of scenario intact? Um, so this is how I respond to this type of email. And keep in mind, I'm not advising you. I'm not telling you this is how you should allocate. I'm simply saying if I were in that situation with about 100 grand in standard margin, which I currently have portfolio margin, but that's a completely different thing. So the majority of individuals that email me are on standard margin, so they're asking these questions based on standard margin. So here, if I was in that situation, here's how I would pursue, an allocation in capital deployment. So first of all, most importantly, how would I go about deploying my capital? And that would depend on the level of volatility in the S&P 500. There's multiple volatility indicators. There's even a volatility indicator for the VIX, VVIX. But the VIX is basically the one that I kind of base everything off because it's the volatility for the S&P 500. The S&P 500 is a huge basket of stocks, and it's very active, and it's a big benchmark in the overall market. So it's just easy for me to use the VIX as my personal capital deployment benchmark, if you will, or indicator. So whenever the VIX is really low, I've done a video about this in the past, but just a quick review. Whenever the VIX is extremely low, so VIX under 17, in current conditions, we're sitting with a VIX at 12.71. So I'm going to keep my deployed capital low. Reason being, I typically am a premium seller, therefore I have a higher risk of buying power effect adjustments, and a buying power effect adjustment will increase the percentage of the allocation that you have in a given position. So say you have a position on, you have $100,000 in your account, and let's say you have a $2,000, short strangle that represents $2,000 in buying power effect, which is 2% of your net liquidity. And let's say overnight, there's a huge upside move in the VIX, that 2,000 buying power effect turns into 4,000. Well, now that represents 4% of your net liquidity. It's doubled. So that's where your buying power effect adjustment risk lies. So the lower the VIX, the higher the buying power adjustment risk in any given position. So when the VIX is under 17, generally 40 to 60% of my net liquidity is going to be deployed, max. And this is just a rough range. Currently, with the VIX this low, I have 10% of my net liquidity deployed. This has just been a really boring, awful market for my style of trading. So this isn't like set in stone, but this is just kind of a good range to keep in mind. When the VIX is approximately 17, kind of middle ground, which would actually be high right now, considering where we've been for the past 2 years roughly. Somewhere between 50 and 70% of net liquidity deployed max. And then when the VIX is above 17, somewhere between 60 and 80 of net liquidity deployed max. So always leaving some cushion for buying power effect adjustment. Because let's say you have 80% deployed, and then you have a buying power effect adjustment overnight, then you could get yourself in a position where you have close to 100% deployed, or 100, or over 100. Then you're going to look at margin calls and whatnot. So there's personal capital deployment rules, personal portfolio allocation preferences, and just a side note that these strategies are in order of my strategic preference. So my strategic hierarchy, what strategy I like best, and then going down. So in high IV percentile strategies, which are it's the realm I stay in the majority of the time. My favorite strategy is this volatility skew spread, where you look for whether there's more implied volatility premium in the puts or the calls, and the majority of the time it's going to be in the puts, and so you'll sell the put naked, and then you'll sell a call spread against it. If there's more premium in the calls than the puts, then you'll sell the call naked and sell a put spread against it. So it's basically like a naked put with extra juice or a naked call with extra juice, depending on which side has more premium, which more often than not is the put side. So that would be, AKA J Lizard. A lot of people may know it as the J Lizard. So in this case, max 20% of intended deployed capital, hereafter referred to as IDC, and then max 5% per underlying. So what do I mean by that? Let's say we're looking at a situation where the VIX is approximately 17, all right? And we've got 50 to 70% of net liquidity deployed max. So let's just say we're deploying 50% of our net liquidity, assuming we have 100 grand, just to keep things simple. 50% of 100,000 is 50,000. So what am I saying here? I'm saying max 20% of that 50,000. So intended deployed capital. So max 20% of that 50,000. And then max 5% per underline. What am I saying there? I'm saying max of 5% per underline. So let's say you're looking at an IWM J Lizard, and you're saying you want to put max 5% buying power effect per underlying. So if you really like this IWM trade, let's say you want to max it out, you would put your buying power effect as close to 5% of that 50,000. So as close to 2,500 as as possible. However many contracts that allows you to do. So let's just say the buying power effect is 250 per contract to keep things simple. Then in that case, you can do 10 contracts, and that's going to max 10 contracts max. So I'm not necessarily saying you should do 5% on every time. You can do 1% per underlying and have 20 different positions on to get to your max 20%. But if you have, say, 4 positions you really love, you can max them out at 5% and that just have 4 at 5% to equate to this max 20%. So the 20% of intended deployed capital is 20% of that 50,000 in this example. So you're looking at 10 grand. Short strangle, same situation. I love short strangles. It's at the very top. It's pretty much tied as far as how much I like to do the strategy. It's pretty much tied with the skew spread. I just like the skew spread a little bit more because I've had so much success with it, and you do have one side with defined risk. So again, max 20% of intended deployed capital, max 5% per underlying. Doesn't necessarily mean you have to have 5% maxed out. I'm just saying I wouldn't personally put more than 5% in any underlying. You have to put a little bit more. I mean, when you have a huge account, say $1 million or more, you can just do 1%, boom, boom, boom. 1% of your intended deployed capital as your max per underlying. But when you have 100,000 or less, then you kind of need to give yourself a little bit more exposure per underlying, or you're going to get nowhere fast. So keep on going down the list here. Naked put, max 15% of intended deployed capital with max 3% per underlying. Still love this strategy. It's just you get a little bit less credit per spread. It's not quite as successful, per my experience, as consistently successful as some of these other strategies. It has a little bit more directional bias, even though the way I approach them, you do give yourself plenty of room for error, for directional error. But I just like these top 2 spreads a little bit better. And next down the list, naked call, same exact as naked put, max 15%, intended deployed capital, max 3% per underlying. Next is a ratio spread. So a ratio spread would be similar to a short strangle, where you have basically you're naked on both sides, but let's say you're 2-to-1 puts to calls, so you sell 2 puts for every 1 call. That would be a ratio spread, or 3 puts to every 1 call, or 5 puts to every 3 calls. You just have whatever ratio you want to do. Max 15% here on the intended deployed capital, max 3% per underlying. Iron Condor, max 20%, and max 5% per underlying. So I'll go up a little bit more here because you do have defined risk on the spreads. So covered call or put, 10 to 25% of intended deployed capital. These are much more capital-intensive strategies because you're actually buying or shorting shares and then selling a call or put against the long or short shares. So the long or short shares are going to eat up quite a bit of capital. So 10 to 25% of intended deployed capital. And notice here, I'm not saying 10 to 25% of net liquidity. I'm saying 10 to 25% of whatever your intended deployed capital number is. In this case, if we're using 50% of 100,000, then we're talking about covered calls or puts being 10 to 25% of 50% of 100,000, so 10 to 25% of that 50,000 intended deployed capital. Short straddle, max 10%, and max 2.5 per underlying. So this is generally a slightly more capital intensive strategy as well, but I don't like it as much because the probabilities of success are generally significantly lower than these higher probability strategies at the top of the list. So I don't like to give myself as much exposure, and I don't like to expose as much per underlying. Put and call credit spreads, max 2 to 5% of intended deployed capital, max 1% per underlying. So again, as we decrease in probability of success, we're going to decrease in max allocation, of intended deployed capital and max per underlying. Butterfly, 2 to 5% of intended deployed capital, 1% underlying. And that brings us to low implied volatility strategies. So strategies that we'll utilize when the implied volatility is near the low end of its 52-week range, and we're anticipating a pop in implied volatility. First one being the put and call debit spread would be my favorite of the low implied volatility strategies. And you'll notice that we're seeing an extreme decrease in max intended deployed capital allocations on these strategies. Again, because the because the probability of success is reduced with these debit style strategies. Therefore, I'm going to deploy less of my capital towards these strategies. But in times like this, where we have extremely low implied or VIX levels, this is one of the few strategies that you can really get away with right now. So I'm doing them, but I'm doing them small in size, which is why I only have 10% of my capital deployed at 90% cash as of now. Hopefully that'll change very soon. So max is 0.5 to 2.5% of intended deployed capital, and then max 1% per underlying. Calendars and double calendars, same exact thing, and diagonals and double diagonals, same exact thing. So this kind of gives you a decent idea of, if I had 100 grand or less and standard margin, how I would go about pursuing my capital deployment rules and how I would allocate. So if I had a clean slate, I would be starting at the top of this list, assuming the market was providing opportunities and high IVP strategies. Otherwise, I would be sticking around here and doing things in the low IVP strategies and just deploying much less capital like I'm doing right now. But there are a few opportunities out there in some of these high IVP strategies. So when I see them, I try to take advantage of them, but they're few and far between currently. In the future, that will change, and this is how I would go about doing things. So hope you enjoy that. Hope that shines some light on any questions that you might have had from a capital deployment, personal allocation perspective. Again, let me just remind you, I'm not an advisor. This is just how I would go about doing it in that scenario. I'm not telling you to do it that way. This is just kind of, little something a little game plan you might build off of, and there's some things you may like, some things you may dislike. You can take off whatever you want. You can modify this however you want. It'll just give you, a nice framework to build off of. So I hope you enjoyed this information. Talk to you soon.